Hello, everyone. I'm Gayatri from Index One, and I'm joined by Chris McAfee and Craig Mill from BX. Today, we'll be discussing advanced tax loss harvesting strategies and the evolving role of active indexing in maximizing tax alpha. Tax loss harvesting is a powerful wealth management strategy that enhances after tax returns by deferring or even eliminating tax liabilities, allowing more capital to stay invested and compound over time. In this session, we'll explore a practical blended tax loss harvesting approach using small cap, mid cap, and international equity models. We'll cover the key elements of an effective tax loss harvesting strategy, including why holding at least 50 stocks enhances harvesting efficiency, when tracking error can be deprioritized, and how strategic portfolio construction and asset allocation across diverse exposures can help maximize tax alpha. We'll have time for questions after the presentation, so please feel free to submit your questions in the chat box as they come up. With that, Craig, could you walk us through some core ingredients of a successful tax loss harvesting strategy?
Yes, thank you, G, and everyone. Appreciate you joining us today. Index One and BX have been studying direct indexing for really since the space was created for retail advisors a couple of years ago. A couple of the key things. One is most tax loss harvesting engines and direct indexing design strategies to track the benchmark. So let's just assume we're talking about the S&P 500, which has 500 stocks in it. You can just buy the 500 stocks and then tax loss harvest them. And by definition, you're more or less going to be in alignment with the S&P 500. There's also customization. So sometimes investors will want to, add or delete names from that 500 or sectors or overweight certain sectors, but they're always trying to keep it back in alignment with the benchmark or the tracking error. And really that's the whole industry was designed to capture losses and without missing the movement of your benchmark. And what BX has done is sort of taken that concept but applying active indexes where we can achieve alpha in the same overall strategy. We're getting investment alpha plus tax alpha. The evolution of direct indexing and what BX does is fairly well illustrated on this slide, which is basically, the first major product that investors used was mutual funds. And from there, they could get, the benefits of having a bunch of stocks all in one ticker. But it was missing a number of things, like you couldn't personalize it. You couldn't control the number of holdings. You were totally subject to the taxes as they were being distributed each year. And that evolved into the SMAs. And what the SMAs did is it essentially said, rather than you owning a pool, you're going to actually own your 50 stocks or whatever number of stocks in there. But you still lack the ability to, sell the ones that you want to sell. You really couldn't personalize it because then you would be detracting away from the third-party sub-advisor that you were saying, hey, deliver this result for me. And then what we've seen over the last 20 years is really the evolution of the ETF market, which brought in, much better liquidity. You can also see all the holdings at the end of the day. But what was missing there was the ability to actually do anything within the portfolio. And you couldn't tax loss harvest the underlying ingredients. The only thing you could do was sell the actual ETF, and then that would either be a gain or a loss depending on what you paid for it. So that's kind of what really then led to direct indexing, which is like, all right, let's just put all the constituents of a benchmark or an ETF into a portfolio, and then periodically let's go through and sell the losers and replace those with replacement securities. And that's kind of what got Index One and BX to start thinking, like, what if we put something else into a direct indexing universe other than a benchmark? What if we actually took a strategy that was in an index, but it was actively managed? And really that's the combined benefit of what we do with Index One. So what I wanted to do is just take a quick peek at the S&P 500 year to date. G, I'm gonna pop over to this chart on the S&P 500. So this is a real time chart year to date for the S&P 500 on Yahoo Finance, and so this is where it started the year, and it's exactly flat for the year. Let's call it 0% for the S&P 500. Now, it started off the year, the first couple months up, in the range of 3, 4, 5%. And then we got to the point of Freedom Day, or the tariff wars, or all the noise that was coming about inflation and the economy and shipping and supply chains and all that. And the markets got spooked. And so starting in March, we started to see the markets drop. So believe it or not, we actually got a 15% drop in the S&P 500 that took place about 5 or 6 weeks ago. And then with the delaying of tariffs and other news, the markets climbed all the way back up to exactly where it started the year. That's just kind of interesting to put that in context. It's been a very strange year. It's been very volatile. But if you had just put your money into the SPY at the beginning of the year, you would be essentially even. So this is our research tool. So every day we go in and not only look at all the major benchmarks from around the world, but we also compare them to our universe of 60 odd actively managed indexes, which is what we then ultimately use to take some of those indexes and put them into tax loss harvesting engines. So right here is the S&P 500 as of yesterday. The S&P 500 ETF trust was up 0.4. If we go up just a little bit higher, by the other big asset class that we look at is the AGG, or the bond market, was up 1.5%. So if you're in a 60-40 portfolio of those two ETFs, as of today, you're up roughly 0.6%, something like that. If I scroll higher, you'll start to feel what it is that makes BX and Index One different. So this is just a diverse mixture of our active indexes. But if I go all the way up to the top, you'll see that our EU index has had a great year. The Smart Alpha is up 18%, the Syntax Defensive 13%, and so on. But if I look to the categories, you'll see international, large growth, value, large growth, international value, tactical. So what we're seeing from our active strategies is alpha, which is exactly what BX does all day long, is searches the world for managers that we think can produce alpha in good markets and bad markets. So I wanted to share that because I think it helps frame, like, if instead of starting with the S&P 500, what if I started with the FT international leaders? And if I did that and was tax loss harvesting, I would actually get this year a lot of investment alpha plus tax alpha. So with that, G, I'll turn it back over to you so we can dig a little bit deeper into both some of these active indexes as well as tax loss harvesting.
Thanks, Greg. Awesome. Chris, over to you. What would you say is an ideal tax loss harvesting strategy, and what are the expected investment and tax alphas?
So thanks, G. I don't know if there's a single ideal tax loss harvesting strategy, but one thing that you want to do, and this one's contrary to the way that we would typically build portfolios, because we believe that in many cases, having a more concentrated portfolio makes it a better environment to create alpha. But what we've done is we've sourced a number of different strategies from within our universe that have a significant number of holdings in them, which almost by definition makes it ideal as a tax loss harvesting strategy, because if you wind up with a portfolio of 300 names, some of them are actually going to be down, right? So, and you'll be able to harvest them on an ongoing basis. So what we did is we took different elements to create a blended global equity portfolio. starting with our US large cap core index, which we designed to very closely track the S&P, but outperform it. And it's delivered on exactly that. We also took a small cap index, a mid cap index, and an international index, and put them into the mix. So in totality, this portfolio has 300 different holdings in it, right? And it's produced very significant. Actually, you can go to the next screen. It's produced very significant outperformance. So you can see actual alpha of about 300 basis points annualized versus that benchmark one is the ACWI ETF. We thought that was the most appropriate benchmark for a global equity, portfolio. So you've got 13.9 versus 10.8% annualized returns. That's 300 basis points right there. So if you're able to produce 200 basis points of tax alpha by ongoing harvesting, you're potentially in a position where you're 500 basis points better off. And that 200 basis points of tax alpha can be very meaningful over time. If you look at compounding at 8% over 20 years versus compounding at 10%, you wind up with 50% more money at the 10%. So it's certainly worth doing it over time. So then we're going to take this portfolio and view it through the lens of a tax loss harvesting engine. G, if you want to switch it over to that. Okay, so our partners at Alpha Athena have a wonderful tax loss harvesting engine. I took the liberty of taking the very portfolio that I'm talking to you about now and assigning it to one of the accounts in the system. And I invested all the cash, $500,000, on January 1st of this year in that portfolio that we're looking at. And then I pressed the harvest the account button. And you can see, even though the market has come all the way back and this portfolio is up 5.4% year to date, you'd still today be able to pick up an extra 54 basis points in excess after-tax return. That's still not bad over the course of much less than half a year. And that's with a portfolio that's done really well. You can imagine that if we ran this exercise a month ago, we would probably have 300 basis points worth of tax loss alpha to our credit. So if you set it up periodically so that you're looking at harvesting the portfolio monthly or quarterly, you'll have many, many more opportunities to generate that extra tax alpha, which can make a big difference to your clients going forward. So that's all I really needed to show there, G.
Awesome. Thank you so much. And from our end, Index One is proud to be the index calculation provider for the BX strategies that we feature today. It's especially exciting to see that these strategies are blended into portfolios for tax loss harvesting, and we're giving advice as a flexible toolkit to align with clients' short and long-term investment goals. To all of our viewers watching, all the BX models discussed in today's session are available on both BX and Index One's websites. If you have a strategy that you'd like calculated in real time as an index and potentially integrated into other portfolios, please feel free to reach out to us anytime. So we're now moving into the Q&A portion of the webinar. Please feel free to submit your questions in the chat box and we'll address them as they come in. In the meantime, Chris or Craig, what are the different methodologies for tax loss harvesting that you've seen so far?
Yeah, basically there are three key ones. So in the United States, if you sell a stock, you have to not buy it back within 31 days or it washes out the benefit of the loss. So one way to do it is if you have 500 stocks, let's say you come through and sell 50 of those. One thing to do is just say, I'm just staying in cash for 31 days. I'll just go back in and buy those 50 stocks. The positive of that is it's simple and we always know what we're going to be buying back, and we're actually going to lower the risk a little bit in the portfolio, but not dramatically. The second thing you can do is convert it into an ETF. So let's say you sell those 50 stocks and you think, all right, well, for the next 31 days, I'm just going to buy the SPY. if that's my benchmark, and I'll just move that money into the SPY after, 31 days, I'll go ahead and sell the SPY and go back into those 50 stocks that I just sold. The third way is replacement securities. So a lot of tax loss harvesting engines will say, okay, if we sell this stock, we already know that we're going to buy that stock. And it's optimizing that daily to find the best replacement security. And so really the third way is to say, if I sell these 50 stocks and capture those losses, what is the best stock that correlates the best with the one I'm selling, so that I maintain that tracking error to the benchmark. Again, after 31 days, if you want, you can sell those replacement securities and go back into your original. But now we've also seen the evolution, let's call this 3B, where you don't go back and buy the one you sold. You just keep your replacement security, and then that becomes your new portfolio, and then you kind of keep doing that process over time. So it really kind of depends how simple or complex the investor and the financial advisor will want to make it. Do they want to kind of sell stocks and buy new ones, or do they want to just sort of capture the losses, go into the SPY, and then go back into the stocks? Those are really the 3 or 4 primary ways that you can approach it.
Thanks, Craig. And how could someone access the blended index model, through investment portals and custodians?
Chris?
There's a number of different ways that advisors can access these models, but if you just get in touch with us, we'll figure out what the best way for you to leverage these is, because it really depends on what your firm's individual tech stack kind of looks like. But we have a number of different partners that are well known throughout the business where you can access and execute our strategies. And then some of our clients just take model delivery directly, and they do the trade order management themselves.
Yeah, and everything that we're showing today, G, can be within a day or two, can be designed and set up so that a financial advisor who custodies at Schwab or Fidelity can go right into their platform and find that tool and bring it right into the iReval or their order management system.
Nice. Thank you both so much for that. And thank you to everyone for your time and participation today. Be sure to subscribe to our email newsletters to stay updated on our next video content. Thank you all for tuning in, and we look forward to seeing you next time.
Thanks, G.